Hello, my name is Nicholas Lomma, and today I will be presenting to you on a court case, the National Mortgage Company Pty Limited versus the Federal Court of Australia. This was held on the 15th of January 2008. It is very important to correctly distinguish the year in which the amount should be classified as assessable. Under Section 6(5) of the Income Tax Assessment Act, income should be recognised as assessable when it is derived. For tax purposes, income received in advance but not yet earned is said to not constitute assessable income. The overview of the presentation will firstly consist of the main facts that were presented in the case, followed by the main issues in the case, then the judgment and the reasoning behind that judgment, followed by the impact that it had on practitioners, and finished off by a reference page. The facts. The taxpayer carried on a business as a mortgage manager. In October 2000, a deed was put in place between the taxpayer and the bank, by which the taxpayer was to acquire borrowers, then submit loan applications and also manage loans. In return, monthly manager's fees was to be received by the taxpayer in respect of each loan. These were also referred to as incentive fees, which were calculated on the basis of loans settled. During the year ended 30th of June 2001, the bank described that the taxpayer received incentive fees or management fees. In the 2001 tax return, the taxpayer included all incentive and management fees as income. In 2006, the taxpayer requested to amend its return, but the Commissioner indicated it was too late to do so and therefore invited the taxpayer to object his assessment. The taxpayer stated that incentive fees should be treated as loans rather than income, and if correct, there should be further amendments in accordance to the tax return. Claimed by the taxpayer was that there was never an agreement with the bank in regards to the amount if the origination subsidies, and instead it was agreed between the bank that funds would be transferred in form of loans. The taxpayer argued that its income for 2001 should be reduced by $234,099. The main issue in the case was whether the payments are assessable income even though income is not yet earned. Also, if payments made by the bank to the mortgage manager were assessable income, or in fact they were loans. The taxpayer's treatment of income strongly suggests that they cannot be deemed to be loans. As the amounts attracted GST, it reinforced the view that it would be not classified as a loan. Incentive fees were not paid by way of loan, meaning that there was no express promise or any implied promise to repay. The incentive fees can be better characterised as partial advance against manager's fees instalments, by which will be payable in the future. Taxpayer was that if incentive fees were to be classified as partial advances of management fees, which would be then payable in the future, then in determining whether income received in 2001 should be relevant, the decision in the Arthur Murray case should be applied. In this case, the decision held was that amounts of income received in one year, which would be earned in a successive year, should not be treated as income received in the year of receipt for tax purposes. At the courts, it affirmed the point that incentive fees should be treated as unearned in the year they were received, because some duties performed by management remain to be performed over the 5 years of the loan. Therefore, in summary, the incentive fees were an advanced part of the managed fees. The taxpayer's appeal failed and the appeal was dismissed with costs. Impact on tax practitioners. The National Mortgage Company versus the FCT collaborates and establishes many issues that practitioners must consider when dealing with assessable income and income not yet earned. In reference to the case, tax practitioners should focus on delivering the point that income should only be included as assessable when the whole service has been delivered. Therefore, it is evident that tax timing is very significant as it affects the tax payable for the financial year, and if recorded in the wrong year, it could place massive risks on the taxpayer. The decisions by the court were the views from a comparable case, the Arthur Murray v. FCT. The legal principles in the Arthur Murray case place significance over the decision by the courts in the National Mortgage Company case. It can be said that when practitioners were to advise clients over the fact of when income becomes assessable, the rulings in the Arthur Murray case can be based upon. Established from the court's decision, the ATO's view on the decision was that fees received in advance of tuition were not to form part of assessable income. The fees would become assessable once the income was actually earned by way of giving tuition. In conclusion, I hope you are now more aware that for tax purposes, income received in advance but not yet earned should not constitute assessable income. Thank you for watching. I hope you learned lots.